what really concerned me about Amazon was the earnings call. I hate to say this, but it reminds me a lot of Enron. Hi guys, it's Stock Harry, and the recession that we were never in has officially ended. Elon Musk is now the CEO of Twitter, and Amazon fell 20% after earnings. We've got a lot to talk about, so let's get into it. Elon Musk is now in charge of Twitter. The CEO and CFO have left the building. The Twitter deal is now completely finalized. The banks moved the money yesterday. It is official. Elon Musk has purchased Twitter. And we got great news for the U.S. economy. GDP accelerated at 2.6% in Q3, which was better than expected, and it also turned our GDP positive. That means the recession that we were never in has officially ended. The technical recession is now over. The earliest we can re-enter a technical recession will be Q1 of 2023. That would once again require 2 quarters in a row of negative GDP growth, which would be Q4 of 2022 and Q1 of 2023. The earliest that we would find out about that would be April of 2023 and possibly not into May of 2023 to re-enter a technical recession. Now, even though we are no longer in a technical recession, there are still some signs that the economy is getting worse and that we might re-enter and actually become a real recession at some point in 2023. Those concerns are coming after a sharp pullback in housing subtracted from the GDP number, and consumer spending also decelerated, increasing at just 1.4%. In addition, U.S. mortgage rates topped 7% officially, which is the highest rate in more than 20 years. This is causing home prices to fall and will further hurt GDP in Q4 and well into 2023. And just like in 2008, the financial banks are starting to collapse. Credit Suisse just decided to close its investment banking business. It is also trying to raise $4 billion in order to stay in business. Credit Suisse shares were down 20% today, and they plan to cut thousands of jobs with around 9,000 fewer staff in 3 years. And the first wave of job cuts involving 2,700 people who are being let go right now. Credit Suisse stock suffered its steepest one-day percentage decline since 1985. That is a larger decline than the crash of 1987. Earnings on Thursday were all over the board with some huge beats and some huge misses. In a minute, we're going to talk about why Amazon stock was down over 20% after hours. But first, let's cover some of the other earnings. Pinterest stock was up almost 10% after hours. Pinterest soared on third quarter revenue beat, and even though pretty much every other company saw a decline in online advertising, Pinterest actually saw an increase in online advertising. Revenue was almost double expectations, coming in at 11 cents per share versus 6 cents per share expected, and the revenue beat was almost $20 million higher than expected at $684 million versus $666 million. Intel also beat earnings with its stock up over 5% after hours. In addition to beating earnings, Intel announced up to $10 billion in cost-cutting measures going through the year 2025. Like Pinterest, Intel doubled their expected earnings at 59 cents per share versus 32 cents expected, and revenue was also a beat at $15.34 billion versus $15.25 billion expected. The one downside that prevented Intel from rising even more is the fact that revenues declined 15% year over year. This is just another example of how, even though a company can have an earnings beat, the actual earnings can be quite bad. Revenue is down 15% year over year, Yet they beat earnings expectations and the stock was up 5% after hours. Apple also had an earnings beat with its stock up just a little under 1% after hours. Apple beat on both earnings and revenue, but iPhone sales and services came up a little bit short of expectations. Apple reported earnings of $1.29 per share versus $1.27 per share estimated. Revenue was also a beat at $90.15 billion versus $88.9 billion expected. iPhone revenue came in a little bit short, almost $500 million short. Mac revenue was a big beat at $11.5 billion versus $9 billion expected. And iPads were slightly short as well at $7 billion versus almost $8 billion expected. The other product revenue combined was a slight beat at $9.6 billion versus $9.17 billion, but services revenue was also a miss at $19 billion versus $20 billion expected. Now, I did listen to the full Apple earnings call, and there were quite a few questions about why Apple's revenue was not better than it was reported, and Apple chalked up the lower sales to supply chain issues, not being able to get products out. Now, I find this to be a bit odd because Apple also said that they did not have supply chain issues with their chips, and that had always been the big problem in the past. So to me, it seems like Apple actually had a pretty significant decline in demand, but they blamed it on supply. I feel like Apple was probably lying on their earnings call. So I'm not really sure what to trust as far as what they said. Apple does not provide explicit official guidance. However, they did provide some guidance on their earnings call for their next quarter, and the guidance came in pretty weak. So I'm not sure how Apple is going to fare over the next few months. I think even though they did have an earnings beat, these are some of the reasons why Apple stock was not up more after hours. Now, Amazon had a huge earnings miss with the stock down over 20% after hours. The stock did recover a little bit of that, finishing the after hours down a little under 12%. In addition to giving disappointing earnings for Q3, missing analyst estimates, Amazon also gave weak fourth quarter guidance. There were no real expectations on earnings due to the fact that they did not give guidance for Q3, but earnings came in at 28 cents per share. Revenue was a slight miss at $127.1 billion versus $127.46 billion expected. The AWS revenue was also a miss at $20.5 billion versus $21.1 billion expected. And advertising was a slight beat at $9.55 billion versus $9.48 billion expected. Amazon's fourth quarter guidance said that they only expect year-over-year growth to be between 2 to 8%. And even more concerning is that the future of Amazon, their cloud services business, or AWS, just recorded its weakest growth to date. Based upon Amazon's Q3 results and Q4 guidance, Amazon is now on track to report an annual loss. They are losing money. To make matters worse, revenues are declining. Things are getting much, much worse for Amazon. And believe it or not, their short-term assets now are lower than their short-term liabilities. Amazon is very, very close to being labeled a zombie stock. Now, I know that's extremely hard to wrap your mind around, the fact that one of the largest companies in the world could be a zombie stock. It's not that hard to understand, though. Take Rivian, for example, a company that's losing a ton of money and at one point had a market cap that was higher than Amazon's. These things happen. Companies become darlings of the stock market. They become the best companies in the world to own. And years or decades later, they are shot down, barely surviving, and nobody wants to trade them anymore. The market, the economy goes through ebbs and cycles where some companies become highly profitable and everybody's buying them, and then years later, nobody wants to touch them. And unfortunately, Amazon is getting to that point. They are barely holding on to profits. They have significant issues with costs, and they're not showing any signs of getting those costs down. Now, what really concerned me about Amazon was the earnings call. It was a complete disaster. When they were asked specific questions about how they were going to reduce their cost and get back to positive free cash flow, they completely avoided the question every single time it was asked. Believe me, the analysts were trying everything they could to get Amazon to give them a straight answer, and Amazon flat out refused. They gave answers like, well, we know we got to get costs down. We're working on that, and that's one of our goals, and we know we got a lot of work to do. When are you going to get back to free cash flow positive? Well, it's something that we're working on, and so long as sales turn around and increase, we'll get back there. Hopium. They were asked specifics on how exactly are you going to get those costs down. Well, we're going to get the cost down by reducing our costs. That's literally what their answer was. Guys, it was a complete disaster. The way they dodged questions on the earnings call, I hate to say this, but it reminds me a lot of Enron. This earnings call reminded me so much of the Enron earnings calls in the years leading up to their eventual demise. This was a complete disaster. Amazon cannot maintain a PE ratio of 100 or more when they're reporting earnings like this and they're dodging analysts' questions in the way that they did on the earnings call. The only reason that Amazon's PE ratio remains as high as it does is because people are not yet willing to let go of the idea that Amazon is this great company, it's this huge conglomerate, and that it's going to grow into its valuation. The fact is it's not growing into its valuation, and the Q4 expectations of an annual 2 to 8% growth, first of all, it'll be lucky if they grow at all, given their current performance. But even if they do grow, and let's just say they hit the top line, their best case scenario of an 8% growth, they should have a PE ratio of 18. Even after the drop after earnings, let's say Amazon closes tomorrow at a stock price of 90, that's still going to leave them with a PE of 80. I hate to say it, but Amazon is on track for its share price to drop by 80% over the next year. Now, I know that seems impossible, but just take a look at Meta, ticker META. That stock is down over 80% from its highs a year ago. And Amazon is on track to do the exact same thing. I have put options on Amazon. I know I made a lot of money. I will most likely be adding on to my Amazon put options. I think Amazon stock is going to drop by as much as 80% by the end of 2023. It appears to be on the exact same path that Meta was. Go look at Meta's early earnings calls back when they first started losing money. That's what Amazon's doing right now. A bunch of hope about things turning around with absolutely zero plan in place to make it happen. Another thing Amazon boasted about on their earnings call was high inventory levels, claiming that these high inventory levels are going to lead to high sales during the holiday season because they have things in stock. The reality of the economy at this point is that people aren't spending a lot of money. People have been hurt by high inflation, high energy costs, high food costs. They're not spending a lot of money. A lot of inventory sitting at Amazon's warehouses is not a good thing, it's a bad thing. Amazon spends a lot of money in warehousing costs in order to hold on to this inventory. And if they're unable to sell through it, that is actually going to hurt their profitability even more than they expect in Q4. Everything about Amazon's earnings were a complete disaster, and the earnings call was even worse than I could have imagined. Best of luck to anybody holding Amazon stock. I will personally be shorting it. If this video was helpful for you, please click the like button and share this video with your friends and family so that they can get this great information as well. And if you want to know more about some of the other earnings that have come out this past week, including what happened with Meta, I encourage you to go watch the last video that I uploaded here.